Every single day your money sits in a standard bank account, someone else is getting rich off of it, while you're getting robbed by an invisible tax. If you have $10,000 in savings right now, the bank is renting your hard-earned cash to generate an 8% profit while handing you back a fraction of a single penny. In this video, I'm going to reveal the exact 3-step system to stop this silent wealth drain, put your cash to work, and claim back the thousands of dollars your bank is quietly keeping from you. And stick around for step 3, because if you jump straight into moving your money without setting up step 2 first, you could walk straight into a costly tax and penalty mistake that most beginners make. Let's get into it. Part 2. The illusion of safety. Let's start with why this mistake is so easy to make. Because on the surface, keeping money in a bank feels responsible. The balance doesn't drop. There's a number, and that number goes up a tiny bit every year, or at worst, it stays exactly the same. In the US, deposits up to $250,000 are protected by the FDIC, so there's genuine safety here. Your money isn't going to vanish overnight. Psychologically, that stability feels like proof that you're doing the right thing. But here's what almost nobody stops to ask. Safety from what, exactly? Banks are not charities. They are businesses, and like any business, they exist to generate profit. So what actually happens to your $10,000 the moment it lands in a checking or basic savings account? The bank takes your cash, re-lends it, charges 8% on mortgages, charges up to 20% on credit cards, makes billions, and pays you a fraction of a single penny. Fair trade? Not even close. Meanwhile, the average US savings account, according to the FDIC, has been paying somewhere around 0.4 to 0.5% annually. Many basic checking accounts pay effectively nothing, 0.01%, which on $10,000 works out to about $1 a year. Let's sit with that gap for a second. The bank borrows your money at roughly 0.01 to 0.5%. They lend it back out into the economy at 7 to 8% or higher. That spread, the difference between what they pay you and what they charge someone else, is one of the primary ways banks generate revenue. You are, in a very real sense, an unpaid investor in your own bank's loan portfolio. Now, to be fair, this isn't some secret conspiracy. It's just how commercial banking has always worked. It's literally called fractional reserve banking, and it's a legal, regulated system. The problem isn't that banks do this. The problem is that most people have no idea it's happening, and as a result, they leave large sums of money sitting in accounts earning next to nothing, assuming that's simply how banking works for everyone. It's not. And that gap between what you're earning and what you could be earning is the first crack in the idea that keeping cash in a regular bank account is the safe choice. Part 3. The silent wealth destroyer. Now, if you think earning 0.01% interest is insulting, what I'm about to show you next is the real reason your bank account is quietly draining. Let's talk about the second, quieter problem. One that doesn't show up as a bank fee or a bad rate, but works even more consistently against you: inflation. Inflation is often described in abstract terms. A percentage, a headline, a Federal Reserve chart. But let's make it concrete. In 2015, the average cost of a dozen eggs in the US was around $2.75. Today, that same dozen eggs frequently costs $4 to $5 or more, depending on the region and time of year. The average cost of a new car has climbed from around $33,000 a decade ago to over $48,000 today. Median rent in most major US metro areas has risen 30 to 50% over the last 10 years alone. None of that is your money disappearing from your account. Your $10,000 is still sitting there, technically untouched, but its ability to buy things, its actual purchasing power, has been eroding the entire time. Here's the math. Using a conservative long-term average inflation rate of 3.5% per year, if you have $10,000 sitting in cash today, and inflation averages 3.5% annually, in 10 years, the $10,000 will only have the real purchasing power of about $7,050 in today's dollars. You haven't spent $1 of it. You haven't lost it to a scam or a bad investment. It simply lost nearly 30% of its value by doing nothing. Stretch that to 20 years, and that same $10,000 in purchasing power shrinks to roughly $4,970 in today's terms, less than half of what it started as. This is why financial educators often call inflation a hidden tax. Unlike income tax, nobody sends you a bill for it. There's no line item on a statement. It's just a slow, invisible leak that transfers real wealth away from anyone holding cash and toward anyone holding assets that grow faster than inflation. Now, your immediate reaction might be, okay, I need to take all my money out of the bank right now and dump it into stocks or crypto. Stop. That is the single worst reaction you could have. And doing that is how people panic and lose everything. Because money sitting in a standard account isn't safe, but moving it blindly is worse. You need an exact structure. That brings us to the 3-step blueprint. Part 4, the 3-step money blueprint. Here's the good news. Fixing this doesn't require becoming a Wall Street trader, and it doesn't require taking on reckless risk. It requires 3 deliberate moves. Step 1. Build a real emergency fund using a high-yield savings account, not a traditional bank. This is the single easiest fix on this list, and it takes about 10 minutes. A high-yield savings account, or HYSA, is typically offered by online-first banks, names like Ally, Marcus, Discover, or SoFi, and as of recent rates, many of them pay between 4 and 5% annually. That's not a typo. It's the same FDIC-insured safety as your current bank, the same instant liquidity, but potentially 40 to 100 times the interest rate. Let's run the numbers. $10,000 at 0.4%, the national average, earns you about $40 a year. That same $10,000 at 4.5% earns you $450 a year. Same money, same safety, same insurance. The only difference is where it's sitting. Your emergency fund, ideally 3 to 6 months of essential expenses, belongs here. Liquid, accessible, and finally earning something instead of nothing. Step 2. Use a mental bucket system to separate your money by purpose. This is where a lot of people go wrong. Even after opening a HYSA, they treat all their savings as one undifferentiated pile. But not all money has the same job. Money you'll need in the next 12 months, bills, emergencies, short-term goals, belongs in that HYSA. Money you're setting aside for something 2 to 5 years out, like a house down payment, can also generally stay in safer, liquid accounts, since you can't afford for it to drop in value right before you need it. But money you genuinely won't touch for 5, 10, 20 years, that's a different bucket entirely, with a different job. And leaving that bucket sitting in cash, even high-yield cash, is where the 3rd step comes in. Step 3. Put your long-term money to work in low-cost, diversified investments. Pay very close attention to these next 2 numbers, because this is where the math completely changes your financial future. For money with a long time horizon, historically, few tools have been as effective and accessible as broad market index funds. Funds that track something like the S&P 500, giving you partial ownership in roughly 500 of the largest publicly traded companies in America, instantly diversified, with historically low fees. Here's the comparison that matters. $10,000 sitting in a HYSA at 4.5% for 20 years grows to roughly $24,000. Solid. But that same $10,000, invested in a broad market index fund averaging a historical rate of around 8 to 10% annually over that same 20-year period, could grow to somewhere between $46,000 and $67,000. That gap, potentially over $40,000, comes from the exact same starting amount. The only variable is where the money was allowed to work. To be clear, this isn't about moving your entire $10,000 into the stock market tomorrow. It's about being intentional. Short-term money stays safe and liquid. Long-term money gets put to work where it has time to grow and recover from any short-term volatility. 3 steps: a high-yield account for safety, a clear system for separating money by timeline, and index fund investing for anything with a long enough runway to grow. None of it requires expertise. All of it requires simply moving money out of the account it's been sitting in out of habit. Here's the entire lesson in 2 sentences. Keeping large sums of cash in a traditional bank account doesn't protect your wealth. It slowly drains it through low interest rates and inflation working together in the background. The fix isn't complicated. It's simply about putting every dollar in the account that's actually designed to do its job. Most people never make this switch, not because it's hard, hard, but because the cost is invisible, there's no crash, no red number, just a quiet erosion that adds up to tens of thousands of dollars over a decade. And if you're wondering how that same logic applies once your money actually is invested, how to avoid the deadly mistakes people make once they've made the jump from saving to investing, that's exactly what we break down in this video right here.